Imagine building a $60 million empire over your entire lifetime. You know, you took the late night risks, you endured the market crashes, you paid your income taxes, your property taxes, your capital gains taxes, every single step of the way.
Right, you paid your dues.
Exactly. And you finally reached a point where you think, okay, my family's legacy is undeniably secure.
Or so you think.
Right? Or so you think. Because buried in the federal tax code is this legally binding plan to take $12 million of that empire in cash the absolute moment you pass away.
It's a pretty brutal reality check. I mean, families spend decades hyper-focused on the climb, right? On accumulating wealth and, building their businesses.
The offense.
Exactly, the offense. But very few allocate that same intensity to the defense of that wealth. And when the music stops, the federal government, they don't accept IOUs.
No, they don't.
They don't take fractions of a commercial building either. They demand liquid cash.
Yeah.
And typically within 9 months.
9 months.
Well,
welcome to today's deep dive, everyone. If you are joining us, your mission is to understand exactly how the ultra-wealthy mathematically secure their legacies against that exact scenario.
it's a fascinating topic.
It really is. Whether you are actively managing a massive multi-generational estate right now, or, you just want to look under the hood of high net worth leverage, you are in the right place.
Absolutely.
Today, we're analyzing some really intense legacy and estate planning frameworks from a specialized family-run agency, and the whole anchor of our discussion is the rapidly approaching 2026 tax landscape. So let's set the foundation here. What exactly happens in 2026?
Well, the landscape shifts dramatically, basically because of the sunsetting provisions of previous tax laws.
Right.
So as of 2026, the individual federal lifetime gift and estate tax exemption is slated to drop to $15 million.
Okay, $15 million.
Yeah. But for a married couple, you can combine those exemptions. So that gives you a $30 million shield. You can pay $30 million to your heirs completely tax-free.
Which, I mean, on the surface, $30 million sounds like an enormous, impenetrable fortress.
It is. I mean, it's a substantial shield. But the critical mechanic of the estate tax is what happens to the assets outside that fortress.
Okay.
Every single dollar above that $30 million limit is exposed to a 40% federal estate tax.
40%. Okay, let's unpack this slowly, because in an audio format, numbers can just become a blur, and the sheer scale of this liability needs to be completely clear.
Yeah, let's look at the math.
Right. Let's look at the case study provided in our sources. We have a married couple with a combined net worth of $60 million.
Right, so we take their $60 million estate and we subtract their $30 million combined exemption limit.
Which leaves $30 million.
Exactly. It leaves $30 million of their hard-earned wealth sitting completely exposed in the taxable zone.
And the tax on that exposed $30 million is that 40% rate. Which brings us to the $12 million tax bill. Now, if I put myself in the shoes of this family, the immediate problem isn't just the sheer amount of money, it's the liquidity, right?
That is the trap. That's exactly it.
Because I might be worth $60 million on paper, but I definitely don't have $12 million just sitting in a checking account. My wealth is tied up in apartment complexes or equity in a manufacturing company, maybe some private investments.
Right, and that liquidity crisis is where things fall apart. Like we said earlier, the IRS gives the executor of your estate just 9 months to pay that $12 million.
So what happens if they don't have the cash?
Well, when families lack the liquid cash, they're forced into fire sales. The executor literally have to liquidate family real estate or sell shares of the family business under extreme duress.
Oh man, and buyers know you're desperate.
Exactly. Buyers know the estate is desperate for cash, so they offer pennies on the dollar. You end up losing far more than the $12 million in lost asset value, just trying to satisfy the tax man.
That is heartbreaking. So our goal today is to explore the specific, highly offensive strategy that prevents this entire cascade.
Yes, there is a way out.
The sources outline a method to turn that looming $12 million expense into a contractually guaranteed victory using something called a lump sum funded irrevocable life insurance trust, or as the industry abbreviates it, an ILIT.
Yeah, the ILIT is basically the ultimate defensive vehicle in estate planning.
Okay, so how does it fix the $12 million problem?
Well, the immediate goal for this couple is to extract $10 million in liquid cash from their taxable estate today. And they use it to preemptively cover that future $12 million problem.
Wait, let's pause right there. Locking away $10 million in cash where you can never, ever touch it again. That sounds terrifying.
It really does.
Even for someone worth $60 million, how does an estate planner convince a client to willingly part with that much liquidity on just a random Tuesday?
It requires a massive psychological shift, I'm not going to lie. But honestly, the math usually does the convincing.
Okay, walk me through it.
The estate planner uses a mechanism called seed funding, or lump sum funding. The couple intentionally makes a massive taxable gift of $10 million to the ILIT.
But wait, if they make a $10 million gift, doesn't the IRS demand immediate gift taxes on that transfer? Like today?
Well, not if it's orchestrated correctly. The couple utilizes a portion of their lifetime gift tax exemption to shield the transfer.
Oh, I see.
Remember, they have a $30 million lifetime exemption available, right? So they just deploy $10 million of it right now.
Got it. So no out-of-pocket gift tax is paid today.
Exactly. It simply reduces their remaining exemption from $30 million down to $20 million.
Okay, let's trace the logic of how this actually executes. Instead of looking at this like a boring legal checklist, let's look at the narrative of how this money actually moves.
I like that.
It basically starts with building an impenetrable vault. You work with an estate attorney to draft the trust documents.
Right, and you must appoint a corporate trustee, or at least a highly qualified independent trustee, to manage it.
So not just a family member.
No, definitely not. This is not a role for your sibling or your best friend. You need true legal separation from your personal estate. You, as the grantor, absolutely cannot manage the assets inside the ILIT.
Wow, okay. So once the vault is built, the couple wires the $10 million in cash directly into the trust's going account, like a single massive transfer.
Yep, and at that point, the compliance triggers. The couple's CPA has to file IRS Form 709.
Which is the United States gift tax return, right?
Exactly. That piece of paper is what officially notifies the government that $10 million of their lifetime exemption has been consumed.
Okay, so the cash is in the vault, the government is notified. What next?
Well, once the cash clears and the compliance is filed, the trustee takes that $10 million and executes the actual leverage. They purchase a single premium survivorship life insurance policy on the couple.
A survivorship policy? I've also heard this called a second-to-die policy, right?
Yes, that's the industry term for it.
Let's break down the mechanics of a survivorship policy because it seems tailored specifically for this marital exemption scenario.
It is. It's precisely engineered for it. See, when the first spouse passes away, there are usually no estate taxes due because of the unlimited marital deduction.
Right, because you can pass infinite assets to your surviving spouse tax-free.
Exactly. The true tax liability only triggers when the second spouse passes away and all that wealth transfers to the children.
So a policy that only pays out on the second death perfectly matches the exact timeline of the IRS tax bill.
You nailed it. And because it covers 2 lives instead of 1, the actual cost of the insurance is significantly lower.
Which brings us to the multiplier. Because the trust uses a single $10 million premium to fully fund the policy on day 1, no further premiums are ever due, right?
Correct. It's one and done.
And based on the couple's age and health underwriting, that $10 million instantly secures a guaranteed $50 million tax-free death benefit.
Let that specific ratio sink in for a second. It is a 5-to-1 contractual multiplier.
That's insane. 10 million goes in, 50 million comes out.
Exactly. When the second spouse passes away, $50 million in liquid cash floods directly into the ILIT.
And it bypasses probate completely.
It bypasses probate, it is completely shielded from income tax, and it flows right down to the beneficiaries.
Giving them more than enough cash to just hand the IRS their $12 million, and they still have $38 million left over.
Right. The family real estate is untouched. The family business remains fully intact.
It solves the liquidity crisis definitively. But, you know, a common objection naturally arises when you look at these frameworks.
Oh, I'm sure you hear it all the time.
I do. People ask, why use a massive lump sum? Why not just use the standard annual gifting strategy?
Right, the conventional wisdom.
Yeah. I hear about annual gifting constantly. The idea is that you just slowly drip money to your kids or to a trust using the annual gift tax exclusion. I think in 2026, the limit is $19,000 per beneficiary per year.
That's correct.
So why wouldn't this couple just use that exclusion to slowly fund a life insurance policy over time rather than, giving up $10 million all at once?
Well, to understand the flaw in that approach, we have to look at why the IRS allows that $19,000 exclusion in the first place.
Okay.
The tax code requires that a gift must be a present interest to qualify for the exclusion. That means the recipient must be able to enjoy the money right now.
Right now.
Yes. You cannot give someone a tax-free gift that is locked in a trust for 50 years.
But wait, the whole point of an ILIT is to keep the money in the trust to pay the life insurance premiums. You don't want the beneficiaries spending it.
Exactly the dilemma. So, estate attorneys use this legal workaround known as crummy letters, named after a famous court case involving a guy named Clifford Crummy.
Gotta love tax law names.
Oh, definitely. So every single time you deposit an annual gift into the trust to pay the insurance premium, the trustee is legally required to send a formal written notice to every single beneficiary.
A physical letter.
A physical letter. And it gives them a short window, usually 30 days, to withdraw their share of the cash.
Wow, so you're basically daring them not to take the cash?
Pretty much.
You send the letter just to satisfy the IRS present interest rule, fully expecting the heirs to ignore it so the cash defaults back into the trust to pay the premium.
That is exactly the mechanism. But think about the administrative nightmare that creates.
Oh, I can only imagine.
Say you have 4 children and 8 grandchildren. That is 12 beneficiaries. If you pay premiums annually, you are sending 12 certified letters, tracking 12 response windows, and filing that paperwork every single year for the rest of your life.
And if you mess it up?
If you miss a letter, the IRS can invalidate the gift and your estate gets penalized.
That sounds like a full-time job just managing the compliance alone. Not to mention the risk that, I don't know, an 18-year-old grandson actually exercises his right and withdraws the cash to buy a sports car, leaving you short on the premium payment.
It happens. And that administrative friction is just the first pitfall. The second is the premium lapse risk.
What do you mean?
Well, if you are relying on annual gifts to fund an ongoing life insurance policy, what happens if your business suffers a severe downturn? What if your cash flow dries up and you simply cannot afford to make the gift for 3 years?
Oh, the policy lapses.
Exactly. You lose the coverage right when your estate needs it most.
Wow, so the contrast is incredibly stark. By utilizing the Unified Lifetime Exemption to fund the ILIT with a massive lump sum on day one, you completely obliterate the administrative burden.
Yep, it's gone.
There are no annual gifts, which means there are 0 crummy letters. And because the policy is fully paid immediately, the premium lapse risk drops to absolute 0.
But you know, the most profound advantage of the lump sum strategy isn't just the administrative convenience.
What is?
It's about the trajectory of the asset's growth. When you move that $10 million into the ILIT, you are not just removing the initial seed money from your taxable estate. You are permanently removing 100% of its future asset growth.
Wait, let's trace the math on that because the compounding effect is really the secret sauce here.
It really is. Think about it. If you kept that $10 million in your personal taxable portfolio and it grew over the next decade to, say, $20 million,
Okay.
that extra $10 million of growth is now also sitting above your exemption limit. It is subject to the 40% estate tax. You have literally grown your own tax problem.
Oh, wow. I never thought about it like that.
Right. By forcing the $10 million into the ILIT on day one, all of that growth occurs entirely outside the reach of the IRS.
You literally cap the size of your taxable estate while letting the leverage compound in a tax-free vacuum. It makes perfect mathematical sense.
It really does.
But let's look at the friction points, because there is no such thing as a perfect financial architecture without trade-offs. What are the blind spots in this strategy?
The blind spots are significant, and they require serious consideration. The first one is irrevocability. The I in ILIT literally stands for irrevocable.
Meaning no takebacks.
None. The moment that $10 million crosses the threshold into the trust, you cannot change your mind.
Yep.
You cannot take the cash back. You generally cannot change the beneficiaries. It is completely severed from your personal balance sheet.
It is a permanent decision. You are giving up control for the sake of certainty?
Exactly. Now, the second consideration is the reduction of your lifetime exemption.
Right, because you use 10 million of it.
Yes. By deploying $10 million of your exemption today, you have less capacity to shield other appreciating assets later on. If your business suddenly triples in value, you have less exemption left to protect it.
That's a fair point. And what about accessing the money while you are still alive? Like, can the trust tap into the cash value of that massive insurance policy if there is an emergency?
That brings us to the third blind spot, the Modified Endowment Contract Rules, or MEC rules.
MEC rules?
Yeah, this requires a little bit of historical context. In the 1980s, wealthy individuals were stuffing millions of dollars into life insurance policies just to use them as tax-free investment accounts.
Ah, a classic loophole.
Classic. They would overfund the policy and then take tax-free loans against the cash value to fund their lavish lifestyles.
And I imagine Congress did not appreciate losing all that tax revenue.
They certainly did not. So Congress created the 7-pay test. Essentially, if you fund a life insurance policy too quickly, like, say, dropping a single $10 million premium into it, the IRS classifies the policy as a modified endowment contract.
Does that ruin the death benefit?
No, the final death benefit remains completely tax-free to your heirs. That structural advantage is untouched.
Okay, good.
But if the trust attempts to take lifetime loans or withdrawals on the policy's cash value, those withdrawals are taxed as regular income. Furthermore, if you take them before age 59 and a half, you get hit with an additional 10% penalty.
Yikes. So the vault is truly locked. The payout at the end is mathematically secure, but you absolutely cannot break the glass early without severe penalties.
That is the trade-off.
The precision required to execute this, from calculating the exemption limits to navigating MEC rules and corporate trustees, it just proves this is not a weekend DIY project. You cannot map this out on a napkin.
No, it requires premier architects. You need an estate attorney, a specialized CPA, and a credentialed financial professional, all working in absolute unison.
Speaking of architects, we're going to take a quick break from the strategy for just a second, because, if you are listening to this and realizing your own legacy might be sitting in the crosshairs of the 2026 tax cliff, you need the right team steering the ship.
You really do.
And that brings us to the sponsors of today's deep dive, Harbor Light Wealth and Retirement Strategies.
Right. If you want to understand how these wealth leveraging strategies and legacy analyses apply to your specific numbers, you need a team that lives and breathes these mechanics. Harbor Light is a premier, family-run agency based right on the South Shore of Massachusetts.
What really stands out about their practice is the sheer depth of their authority. I mean, they bring over 25 years of experience to the table. They hold elite industry credentials like the FIC and FICF.
That's huge.
It is. They have even held membership in the $1 Million Roundtable, which is an honor achieved by fewer than 1% of independent financial professionals worldwide.
Wow.
Yeah. They are not in the business of just selling off-the-shelf products. They coordinate sophisticated, multi-generational frameworks so your wealth actually reaches the people you love, completely shielded from market volatility and tax erosion.
Whether you are exploring an annuity shield or looking to model a leveraged ILIT for your own family, you can connect with them directly to see the math for yourself. You can visit their website at www.harborlightretirement.com.
Or you can give their South Shore office a call directly at 508-618-9991 to schedule a private analysis. Again, that website is www.harborlightretirement.com.
Highly recommend checking them out.
Absolutely. All right, let's pivot back to the strategy. Up until now, our entire discussion has been dominated by spreadsheets, right? Tax codes, exemption limits.
Cold hard math.
Exactly. But when you read the deeper analysis in our sources, there is this profound shift toward the emotional and human impact of the ILIT.
It is honestly the most overlooked dimension of estate planning. We focus so heavily on the mechanics of death, we completely forget the freedom these structures unlock for the grantors while they're still alive.
The concept of giving while living.
Yes, it is a massive psychological breakthrough. Consider affluent individuals who have built incredible wealth and harbor a deep desire to be radically generous.
Like funding a hospital wing.
Exactly. They want to fund a new wing at a children's hospital. They want to aggressively support local charities or build community centers. But there is almost always this quiet, nagging friction.
What kind of friction?
They think, if I write a $5 million check to this charity today, am I stealing from my children's future? Am I compromising the inheritance I promised my family?
Oh, wow. It is the fear of running out even when you mathematically have more than enough.
Precisely.
It reminds me of, hosting a massive, lavish wedding reception.
Oh, that's a good analogy.
Right? You want everyone to have an incredible time, but you are secretly terrified the caterer is going to run out of food halfway through the night.
That's so true.
So you hold back. You don't even enjoy your own party because you are constantly guarding the buffet line.
That is the exact psychological state of many high net worth individuals. They're defensive hoarders. But the ILIT is what prepays the ultimate reception.
Because the kids are taken care of.
Exactly. Once that $10 million premium is paid and that $50 million tax-free inheritance is contractually locked in a vault for the next generation, The heavy anchor of financial anxiety is severed.
You have mathematically guaranteed your family's legacy. The IRS is neutralized, the kids are fully covered by the trust, the family business is shielded.
And suddenly you are instantly liberated.
You have permission to write those multi-million-dollar checks to charities right now.
Yes, you get to sit in the front row, shake hands with the people you are helping, and actually witness the real-world impact of your life's work.
That is beautiful. The life insurance policy transcends being just a death benefit. It becomes a mechanism that grants the family permission to transition from a mindset of defensive preservation to a mindset of absolute abundance and radical generosity today.
It completely changes how they live the rest of their lives.
That shift in perspective is profound, but, it leads to the ultimate question, one we really cannot ignore given the political reality.
I think I know where you're going with this.
Tax laws written in pencil. What happens if Congress suddenly moves the goalposts? What if the federal exemption limits don't just drop to 15 million, but plummet to 5 million?
Or what if a new administration pushes them up to 50 million?
Exactly. Does this entire ILIT architecture fall apart if the legislation changes?
This brings us to the macro truth of wealth leveraging. The structural integrity and the emotional peace of mind behind these frameworks remain an undefeated advantage regardless of what happens in Washington.
Okay, walk us through the scenarios. If the government drastically lowers the exemption limits, what happens to the family?
Well, if exemption limits drop, the estate tax exposure violently expands.
Yes.
Suddenly, an enormous portion of your wealth is sitting in the taxable zone.
Making things worse.
Much worse.
Right.
In that restrictive environment, the ILIT is no longer just a clever strategy, it becomes an absolute necessity.
Right.
It provides the exact, contractually guaranteed liquidity your executor will desperately need to satisfy the expanding tax burden without liquidating your life's work in a fire sale.
And in the opposite scenario, what if the laws change and the exemption limits stay high, or the estate tax is somehow completely diminished? Did you just waste $10 million?
Not at all. If the immediate tax threat diminishes, the math still wins. You have taken $10 million of liquid cash and utilized a 5-to-1 contractual multiplier to guarantee a $50 million tax-free payout. You have safely removed that massive seed money and 100% of its future asset growth from probate, from lawsuits, and from future income taxes.
Wow.
That wealth compounds across generations with a certainty that the equities market and real estate simply cannot replicate.
So whether the legislative tide comes in aggressively or the tide recedes entirely, the structural integrity of your family's wealth is permanently locked in.
Exactly. The tax code will always be a moving target.
Yeah.
But the mathematics behind contractual asset leverage are permanent.
I love that. Well, I want to leave you with a final thought to mull over today. We spend decades hyper-focused on the climb. We obsess over accumulating more, earning higher returns, and building a bigger empire.
We all do it.
But what if the ultimate financial achievement isn't about endlessly accumulating more? How would your own financial decisions change today if you stopped focusing entirely on accumulation and started focusing on optimizing what you already have for absolute, unshakable certainty?